A financial earthquake just hit Tokyo, and Wall Street is pretending everything is fine. On January 20th, 2026, something happened in Japan that hasn't occurred in 3 decades. Japanese 30-year bonds hit 3.9% yields. That might sound technical. That might sound irrelevant to your retirement account. But here's what the media isn't telling you. The US Federal Reserve just had to step in and rescue Japan's currency to prevent your portfolio from collapsing. This isn't a drill. This is the beginning of a $20 trillion forced sell. And in the next 12 minutes, I'm going to show you exactly why your wealth is at risk and what you must do in the next 60 days. Let me give you the background so this makes sense. Japan carries a debt burden of 250% of GDP. Think about that for a second. Japan owes 2.5 times everything their entire economy produces in a year. No major economy has ever survived debt levels this extreme long term. For 30 years, Japan ran an experiment. They kept interest rates at 0. Sometimes negative. They told their citizens, "Don't save money. It earns nothing. Spend it or invest it overseas." And that's exactly what happened. Here's the timeline. December 2025. Bank of Japan raises rates to 0.75%. First rate increase of this magnitude in 30 years. They abandon yield curve control. Bond yields explode in response. The 10-year Japanese government bond went from 0.5% to over 2% in under 6 months. The 30-year bond hit 3.9%. Financial experts call this a Six Sigma event. Statistically, this should happen once every 100 million years. But it's happening right now, and it's accelerating. Now here's where your money comes into play. For 3 decades, Japanese investors, banks, pension funds, and insurance companies have been running what's called the carry trade. Here's how it worked. Step 1. Borrow yen in Japan at 0% interest. Step 2. Convert those yen to US dollars. Step 3. Buy US Treasury bonds, paying 4 to 5%. Step 4. Pocket the difference. It was literally free money. Zero risk. Guaranteed 4 to 5% annual returns. The greatest trade in modern financial history. Japan holds $1.2 trillion in US Treasury bonds. They're the largest foreign holder of American debt. Bigger than China, bigger than any European nation. But here's the problem. The math just broke. Japanese bonds now pay 2% to 3.9%, depending on maturity. US Treasuries pay around 4.8%. So ask yourself this. If you're a Japanese investor, why would you convert your yen to dollars, which creates currency risk? Send that money to America and buy US bonds at 4.8%, when you can stay home, buy Japanese bonds at 3.7% with zero currency risk. You wouldn't. It makes no sense anymore. The carry trade is dead. And that means Japanese investors are going to sell. They're going to liquidate hundreds of billions, potentially over $1 trillion of US Treasuries in the next 12 to 24 months. But it gets worse. Hedge funds saw this free money and thought, if we can make 5% risk-free, what if we leverage it 10 times? We make 50%. What if we leverage it 20 times? We make 100% annual returns. And they did exactly that. Nobody knows the exact number because hedge funds don't report positions publicly, but major bank estimates suggest the total leveraged carry trade exposure is $15 trillion to $20 trillion. That's $20 trillion in positions that are now underwater and must be unwound. We already saw a preview of what's coming. In August 2024, the Bank of Japan surprised markets with a small rate hike. The carry trade started unwinding. Here's what happened in 72 hours. Bitcoin crashed 23%. Nasdaq dropped 10%. S&P 500 fell 8%. Over $2 trillion in market value evaporated. And that was just a tremor, a warning shot. The rate hike was small. The unwind was limited. What's coming now is the full earthquake. The rate hikes are bigger. The unwind is massive, and there's no emergency brake. Morgan Stanley analysts published a report stating, We are witnessing the most significant unwinding of carry trade positions in modern financial history. Maybe you're thinking, I don't own Japanese stocks. I don't invest in Tokyo. This doesn't affect me. Wrong. Here's how this destroys your wealth. Your tech stocks you own, Apple, Microsoft, Amazon, Tesla, and maybe directly, maybe through your 401k. These stocks have been driven higher by cheap money and low rates for years. When Japanese investors and hedge funds close their carry trade positions, they don't just sell U.S. bonds. They sell everything. They get margin calls. They need to raise cash immediately. So they dump stocks. They dump crypto. They dump real estate. They sell anything liquid. This is forced liquidation. It's indiscriminate. Your Microsoft stock gets sold, not because Microsoft is failing, but because a hedge fund in New York needs cash to cover blown-up yen positions. Your real estate mortgage rates are tied to long-term Treasury yields. If Japanese selling pushes the US 10-year Treasury from 4.8% to 5.5% or 6%, mortgage rates follow. 30-year mortgages at 7% now could hit 8% or 9%. Housing affordability collapses. Home prices fall. Your crypto, when institutions de-risk Bitcoin and Ethereum, are the first assets sold. We saw this in August 2024. Bitcoin dropped 23% in 3 days. That's going to happen again, potentially worse. The 60/40th portfolio myth. Traditionally, when stocks fall, bonds rise. That's how diversification works. You're hedged. But when government creditworthiness itself is questioned, stocks and bonds fall together. The hedge breaks, the correlation flips. You get destroyed on both sides. Ken Griffin, founder of Citadel, just warned about exactly this. Bonds lose what makes them special in a portfolio when bonds and stocks move together in price. Translation: your hedge is gone. Your 60/40th portfolio is now 100% risk. According to Bank of America, half of all major institutional money managers currently have zero downside protection. No hedges. Fully exposed, everyone is on the same side of the boat, and when everyone tries to exit simultaneously, the boat capsizes. Here are the specific warning signals that tell you this crisis is accelerating. Trigger number 1, U.S. 10-year Treasury yield above 4.75%. This signals foreign selling is overwhelming demand. Trigger number 2, U.S. 30-year Treasury yield above 5%. This is a crisis signal. Long-term rates are spiraling out of control. Trigger number 3, dollar-yen exchange rate below 140. If the yen strengthens rapidly, carry trades are unwinding fast. Japanese investors are selling dollars, buying yen, bringing money home. Trigger number 4, volatility index, the VIX, above 25. Fear is spiking. Institutional panic is setting in. Watch these levels daily. When 2 or more trigger simultaneously, the crisis has entered the danger zone. And here's the part almost nobody is discussing. It's not just Japan. Europe holds approximately $3 trillion in US Treasury bonds. That's triple what Japan holds. European governments are broke. They're facing massive pressure to increase defense spending because of Ukraine and NATO obligations. They need to spend 3 to 4% of GDP on military. Where are they getting that money? By selling assets. And one of the biggest, most liquid assets European governments hold is US Treasury bonds. So you've got Japan selling, you've got Europe selling, and the US Treasury's response. Treasury Secretary Scott Bessent was asked about this at Davos. His answer: I've been in touch with my counterpart in Japan. I'm sure they will begin saying things that will calm markets down. Signing things, not doing things, not implementing solutions. Just talking, when the Treasury Secretary is hoping Japan will say nice words to calm bond markets. You know, there's no real plan. The adults are panicking, and they're out of tools. So what do you actually do? This isn't about getting rich. This is about not getting poor. Here's the defensive strategy. STEP 1. Assess your current exposure. Go look at your portfolio today. How much is in stocks? How much in bonds? How much in cash? If you're heavily weighted in stocks and bonds with no hard assets, you're in the danger zone. STEP 2. Defensive sector positioning. What to hold? Energy, ExxonMobil, Chevron. Essential demand, dividends, pricing power. Materials, gold. The ETF ticker, GLD, silver. The ETF ticker, SLV. When governments are in crisis and currencies are unstable, gold holds value. Quality tech, Microsoft, Apple, Google. Fortress balance sheets, massive cash flow. Consumer staples, Coca-Cola, Procter & Gamble, Walmart. Recessioned. What to avoid? Regional banks. They're sitting on unrealized bond losses. Potential failures ahead. High-debt companies. Bankruptcy risk when rates spike. Consumer discretionary. Luxury spending collapses first. Speculative tech. Unprofitable companies burning cash. Step 3. Hard asset allocation. Move 10 to 20% into hard assets that aren't someone else's liability. Physical gold, physical silver, Bitcoin, if you understand the volatility. These aren't tied to government solvency. When bonds break and currencies weaken, these hold value. Step 4. Avoid the cash trap. Many investors say, go to cash and wait it out. Primera, disa, gri. If the Fed restarts key to bail out the system, they'll print trillions. The dollar weakens. Inflation spikes. Cash loses purchasing power. Cash is useful for short-term liquidity. It's not a long-term safe haven in this environment. Step 5. Monitor the trigger points. Check the 4 triggers daily. 10-year Treasury yield. 30-year Treasury yield. Dollar-yen exchange rate. VIX, volatility index. When multiple triggers fire, increase defensive positions immediately. The bottom line is this: Japan's carry trade unwind isn't theoretical anymore. It's happening right now. Japanese bond yields are at 30-year highs. The Fed is intervening in currency markets. US Treasury yields are spiking. We're in the early stages of what could be a $15 to $20 trillion forced liquidation. Your portfolio is exposed whether you realize it or not. The traditional 60/40ths diversification won't protect you. The correlation has broken, and the next 60 to 90 days will determine whether you're positioned correctly or whether you watch your wealth get cut in half. This isn't about fear. This is about mathematics. The carry trade math doesn't work anymore. Japanese investors will sell. Hedge funds will unwind. Markets will fall. The only question is whether you see it coming and act accordingly, or whether you ignore it and hope it goes away. Hope is not a strategy. Math always wins. And the math says this crisis is accelerating. If this analysis opened your eyes to what's really happening and why it matters to your financial future, hit that subscribe button right now and turn on notifications. My next video is going to reveal the exact 30-day timeline for how this unfolds, the specific dates to watch, and the precise defensive positions take at each stage. You cannot afford to miss it. Stay sharp, stay informed, and don't let this crisis blindside you. I'll see you in the next one.